Hi, I'm Bryan Rich with Money Markets TV. Remember 2007 when the subprime crisis began to unravel? Even after the problem had spread from the real estate market to the entire financial system, President Bush, Treasury Secretary Henry Paulson, and Federal Reserve Chairman Ben Bernanke kept telling the public not to worry. But then, the message from government officials turned on a dime. Suddenly, Paulson was asking Congress for $700 billion to avert a total global meltdown. If the Troubled Asset Relief Program wasn't approved, they said more banks and other businesses would fail, the stock market would drop even further, foreclosures would skyrocket, it would be harder and more expensive to get credit, millions of Americans would lose their jobs, and the country would experience a long and painful recession. Well, as we know, they got their $700 billion, but we still got all of the above and then some. Many investors were caught on the wrong side of this collapse in the financial markets that followed a freeze in credit and the sharpest downturn in the global economy since the Great Depression. But the pain isn't over. In fact, there's another act of this saga playing out right now, and this time its roots are in Europe. And it's not private debt that's threatening the global financial system, it's public debt. Just like in 2007, government officials have tried to shore up confidence by saying the problem is contained. They've denied that any country in the Eurozone would fail, and they've rolled out numerous plans in an attempt to resolve the crisis. Yet we continue to see the dominoes fall, and we continue to see the probability of a default by a Eurozone member rise. European officials have managed to extend the timeline of the fallout, but they've done nothing to change what seems to be the inevitable outcome. The fact is, the Eurozone debt crisis could make the subprime crisis look like just the opening act. European banks are heavily exposed to the sovereign debt of weak Euro members, and asking creditors to take a haircut on their investments means that those banks would have to eat losses. And that's exactly what European officials are trying to avoid. Instead, the EU and IMF are asking the people to absorb all of the pain through tough austerity measures. But the people are beginning to rise up and demand that the burden be shared. First it was Greece, then Ireland, and now Portugal looks like it's days away from requesting a bailout. Last week, the Prime Minister in Portugal presented his plan for tough austerity measures to Parliament to rein in the unsustainable debt and deficits that have pushed Portugal to the edge of insolvency. But Parliament voted it down, and the Prime Minister in Portugal promptly resigned. Portugal has sent a clear message here to the European Union and the International Monetary Fund. The people are not willing to absorb all of the pain. So either Portugal will end up rejecting a rescue, or the EU and IMF will compromise their terms. Either way, it destabilizes the financial system. So as you can see, it's no win all the way around. The question now is, will Portugal be the linchpin that collapses the euro? If so, expect the reverberations to be felt across all markets. I'm Bryan Rich from Money Markets TV. Thanks for watching.